Alright guys, welcome back to MMG Invest and WolfPack Cryptos. Let's do some TA on the stock market, see if there's any chance of a rebound. And I'm also going to dive into some fundamentals. I do not want to make an extremely long video because people's attention spans and, people have jobs still. And let's find out if people are going to have jobs much longer. First of all, this is not financial advice. Consult your financial advisor. I am not your financial advisor. Once this video is uploaded, it's pretty much obsolete. Do not trade or invest anything you're not willing to lose or lose sleep over. Learn to trade. Have your stops in place. Emotions out. And the links are below this video for our free chat rooms. The newsletter and the research for gold, silver mining stocks is coming soon in about 2 weeks. The 1st of 2019, that's what I'm shooting for. And I want to make sure it's good quality, good information, very detailed, everything you need. And it's very time consuming researching all of those, but it will come. I also have a website pretty much built already, a new one for MMG Invest, separate from WolfPack Cryptos, and I'll keep you guys updated on that. Okay, let's take a look at the S&P 500. Here's the daily chart. I put up a Fibonacci from the breakout from the beginning of 2017, and these retracements are percentage bases, and the Fibonacci's, it's a fractal based on human psychology, and prices tend to visit these percentage support areas based off of the Fibonacci indicator tool. Now, for some reason, the Fibonacci works pretty good in the stock market. It's probably because a lot of algos and hedge funds actually they set their algorithms to these tools and indicators, and traders tend to use them as well. So it's like a self-fulfilling prophecy. Now, looking at the Fib, let me zoom out for a second so you guys get a bigger picture. So here's 2009, right? This is when the economy almost imploded for the United States after the mortgage-backed security crisis. This is 2002 after 2001. Right, and the bursting of the Nasdaq, the dot-com bubble, and we had a bear market back then as well. It only lasted a couple years, and then the markets recovered. But the 2008-2009 crisis, it doesn't look too much worse than the one in 2000 and from 2000 to 2003. But it is much worse. This because the banks almost imploded, and there would have been a run on the banks, money market funds, everything was going to freeze. People don't even know that food being delivered to stores was like a week away from not being delivered, because everything runs on money, especially shipping. Right, so things could have became very, very bad, chaotic. Now, if the Federal Reserve did not bail out the banks and start printing massive amounts of money, and done QE 1 through 3, and put about 4.5 trillion on its balance sheet, we would have gone into a Great Depression in 2008. But we didn't, because they bailed everything out and kicked the can down the road. Ironically, the government didn't stop spending after that. They actually ramped up spending, and you know, the wars and the welfare, all of it, it just kept going. So we are here today in 2000, it's about to be 2019 in just about 2 weeks from now, right? So it's going to be significantly worse when the stock market crashes. Not if, but when. It's 100% certain it is going to crash. The question is, has it begun in recent weeks? And that's what I'm trying to figure out. So, looking back, you can see 2009 right here. And here was from 2000 to 2003. So let's see, where are we? Now the initial drop, I'm going to take a ruler, I'm going to measure it from the peak here, was a 20% drop, right? And there's a rule. Once you see a 20% drop from the all-time highs, you are officially in a recession. One could argue it could be just 15% and you're in a recession. But we've seen 15% drops and the market recovered. So the current drop, where is it? By the way, today is, for reference, it's Thursday, 9 p.m., December 20th, 2018. So from the all-time high, currently we have dropped about 17%. So we're just 3% away from 20%. So just knowing that, let's take a look at the smaller time frames, and let's look at, is there any support to stop us from falling 3% more? Well, there is a minor support at 2,400 on the S&P 500. So if this support, if the price could bounce off of it and somehow rebound and go higher and get back above, it would have to get back above 2,600, which is it's likely we could see a rebound back up into this area where it broke down from my descending triangle. But the problem is this is going to act as major resistance. And that's when the fundamentals and the news and what's going on currently is going to matter and really be the deciding factor. It's not going to be just technicals. See, I do both. Technicals, fundamentals. I also look at the news, although, you know, the news, the only reason I look at it is I usually tend to do the opposite of what they're saying. But, you know, I have different sources of news, which is more accurate and true. So, this minor support at 2,400 needs to hold, especially this week. So, tomorrow, the market cannot fall below 2,400. Now, if it does, then it's going to be at the 20%. And it's going to, more than likely, the price is going straight to this moving average, which is a 100-day moving average at around, well, 2,400. So this area. Let me make this box a little thinner. So this white rectangular box right here, this is a support area, the next support area. Now, right below that, we also have the 78.6 percentile Fibonacci retracement. And this should also act as major support where you could see a bounce or a rebound. And we also have the 100-day moving average, or the 100-week moving average right above that. So, I'm sorry, this is a weekly chart. Each candlestick represent a week. So, we are coming up on some support. you can see there was a little bit of a bounce. Let me take this to a daily so we get a better idea of what's going on here. So, I mean, look at this. The Fed, the FOMC meeting, right? Wednesday, yesterday. I covered it live, and we watched the market drop by a lot. Like 400 points. But the market started really dropping the day prior to it. And I guess the Fed was not, the Federal Reserve Chairman Powell, he was not dovish enough, yet he was still pretty dovish. But the moment he actually said that they will not do any more accommodative QE or money printing, pretty much, they will only lower interest rates, which is, and they cut back to only 2 rate hikes in 2019. That still wasn't dovish enough, but the fact that he said that they will only cut rates if they have to, but they'll still let their balance sheet mature and run off, meaning all of the debt that they've accumulated and all of the mortgage-backed securities and government debt and whatnot, they're going to still let it mature and roll off their balance sheet, meaning that's going to still suck money out of the system. That's blown a bubble in the stock market and everything else. So the markets didn't like that. And they wanted to hear Powell literally capitulate, meaning they were still expecting a rate hike, but they wanted to hear that this is the last rate hike. In 2019, there might not be any rate hikes. That's what the markets really wanted to hear. The problem with that is, if the Fed says that, that is an admission that the economy is so weak that it can't handle more than 3% interest rates on the short-term debt. And that's another admission that we're going into a recession anyways because the economy is that weak. And at the same time, we have Trump and the mainstream media and everyone saying that the economy is strong and it's never been this strong before. And yeah, like I've said, this is the second longest bull market running in history. And what happens before every crash and correction? Well, it's the economy's the strongest it's ever been, and then all of a sudden, out of nowhere, it crashes, right? And that's when everyone wakes up to reality, and the confidence game is over. And earnings reports have not been that great. FedEx recently just came out and said that they see less volume, they have less revenue. Now, what does that tell you? Now, FedEx is one of the largest, if it's not the largest, package delivery service for the entire nation, right? And if their revenue's falling and their volume of packages is falling, that means people aren't buying as much. I mean, that's just a fact. Now, if the economy's healthy, then why are people buying less? Especially since Christmas is like a few days away, right? The volume should be at all-time record highs, especially if the economy's recovering and booming and doing better than just a year ago or 2 years ago. And the reality is it's not. The last 2 years, it seemed like the economy was getting better, but it's really just how the Federal Reserve and its mathematicians over there cooking the books and doing the stats, the way they measure unemployment, it's not correct. They've changed it. And I forgot what year they changed it, but they used to measure it differently. If you go to shadowstats.com, if you measured it the way they used to, like 20 years ago or 30, something like that, the unemployment's much, much worse. Inflation is much, much higher, and things are not as rosy as they look. Also, there have been jobs made, but they've been made under false assumption companies started hiring when Trump got elected because he's more of a pro-market guy, cutting regulations and taxes, and companies just started hiring people. Unfortunately, they shouldn't have been hiring those people, and they're probably going to start letting them go. So it's just like there's malinvestment, there's mal hiring, I guess. I just made that up. Okay. So, and then also you see a lot of hiring with part-time jobs, right? And waitresses, service sector jobs, which don't really help the economy in the long run. You're not making anything. You're just a byproduct of some company that actually does make something. But as we know, industrial jobs, they're not really coming back, guys. I mean, we just saw a major Ford plant lay off employees and whatnot. And also, I forgot to bring up a chart. I'll bring it up next time. Car sales have been dropping. And Ford came out with an article or an analysis, a report, and what they see is there's going to be less car buying in the coming years. Well, for one, we know there's different demographics, right? The baby boomers, the older people, they're going into retirement. They might buy one more car, but a lot of them they're already going into retirement and they've already bought their new car. And it's going to taper off. And who has the most money? It's people like above age 55, to be honest. Let's be real. And it's the baby boomers. And not just that, I mean, the supply of cars is just enormous. There's like 4 cars for every person in the United States. At some point, people have already bought their cars. And not just that, the U.S. savings rate has deteriorated. Most people don't have savings. Most Americans actually have less than like $2,000 saved up, which is it's nothing. I mean, that's really bad. Not just that, 7 out of 10 who are about to retire, their retirement isn't going to be enough for them to make it like 10 years into it. So people are going to cut back. Not just that, because of artificially low interest rates, people have been able to rack up them credit cards, including corporations and small businesses. Everyone's been binging on debt for the last like 10 years again, and because of low interest rates. Because people are incentivized to spend, not save, when you have really low interest rates. Because your money's not doing anything in the bank except losing value through inflation, right? So you're forced to search for yield, and you're also forced to take advantage of low interest rates. All right, so let's get back to the charts. This is the daily. Now, here's something really obvious and negative. You see these moving averages? They're starting to cross. This is the 50 and the 100-day moving average. Those are about to cross to the downside. And then the 100-day and the 200-day, they haven't crossed, but the moving averages are starting to roll over. And that's also very bearish. Now, we've seen that in the past, and the market has recovered. Where's the last one? Where was the last time this happened? It was 2016. So we saw the 50 and the 100-day cross. We've even seen the 50 cross the 200-day, and the market's recovered in 2016. And I remember that gold and silver took off, and I made a lot in early 2017. No. Yeah, no, it was 2016, early 2016. So, also, another thing I wanted to point out, you see early 2018, the markets had a huge correction. Then they went a little higher, and we just had another correction. But this time around, we fell out of the descending triangle. That's very bearish. Now, this is called a broadening top. And you know, the theory behind it really is that when you start getting to towards the all-time high of a market, what happens is you run out of buyers. You just run out of people who are buying, and money runs out. If everyone's all in and there's really not too many people left to buy, what happens? The only thing that could happen is the prices go down. Because if nobody's buying and just one person selling, what happens to the price? So pretend there's nobody buying, 0 people buying, and one person sells and they market order. Well, the price could just drop to 0 instantly like that, because there's no buys anywhere. So that's how markets crash, guys. That's why markets take the stairs up and take the elevator down. Because when the top is in and there's no more buyers, nobody's buying, and everyone just starts selling all at once. And then it's kind of like everyone's in a movie theater heading for the exits, and not everyone's going to get out. Only the first people are going to get out. Because when the market starts crashing, there's nobody who's going to step in front of the falling knife. So there's no orders in the order book to handle and to absorb the volume of selling. So all that the price could do is just keep dropping and dropping and dropping until some buyers step in the way of the falling knife. You have to picture that. All right. So the moving average is very negative. The fact that we made a whole new low from the previous low in 2018, very negative. And we are 3% away from a 20% correction. Once it's gone over 20%, even mainstream media has to admit, and they have to, you know, say the obvious. All right, I guess we're in a bear market. And the problem with the bear market this time around is that it's such a large bubble, and it's not just one asset like mortgages for homes. It's an everything bubble, absolutely everything, because of these artificially low interest rates and all of the QE, quantitative easing, and money printing. Everything has become a bubble because of malinvestment and the artificially low interest rates. When there's cheap credit and people are searching for yield, they throw money all over the place wherever they can, and it creates malinvestment, creates bubbles, and when it pops, it's going to be really painful. And the saddest part about all of this is, because the dollar is the world reserve currency, it's a global bubble. And other central banks all around the world have done the same exact thing as the Federal Reserve, because they sort of had to after mortgage-backed security crisis, because that was systemic globally. And you know, but it was different in different regions. China didn't really feel it last time. Australia didn't feel it at all. Their housing bubble has been going for like 3 decades, something insane. But that finally popped as well. Anyways, let me get back to the charts. Just looking at the charts, it looks bad. We cut through the 61.8% Fibonacci like it was nothing. We cut through the 50% like a hot knife through butter. We cut through these moving averages fairly quickly. The 200-day moving average sorta held up the price, but on the third attempt, it just fell right through it. So this is starting to look like a crash. Let me make this clean and zoom out to show you what it really looks like. I will get rid of the moving averages. This looks really bad. it didn't even form the triangle. It didn't even finish it before it started crashing. And Jerome Powell and the Fed really did not help yesterday. I think the investors are waking up to the fact that the Fed is screwed and they can't really do much. Meaning they can't keep raising interest rates because they're going to pop their own bubble. And they can't admit that the economy is so weak that it can't handle more interest rate hikes, because that means that the economy's weak and it's going to correct. And we're going into a recession anyways, so the stock market is going to sell off anyways. Plus, PE ratios in these stocks are so overvalued. They're like 20 times. They're priced like 20 years into the future. So this was coming either way. I mean, everything was overvalued by a lot. All right, let's just say that. Now, comparing this crash currently that's been playing out since it's been playing out for about a month and a half now. Let's take a look at some similarities with the 2009 crash. Look at this. I forgot how to copy and paste this. Actually, I do have... Here we go. So here's the 2007-2009 crash, right? And they're lined up. They're placed on top of each other. So 2018 is the blue line, 2009 crash is the red line, and they're very similar. So remember, this is 2009 crash, okay? So the initial drop. Now look at the similarities here. We had a pretty decent drop. Then it rallied again. Made a new all-time high, but not much larger. And then it dropped again. And that's what a broadening type top is. Where it tries to rally again and make new highs and go back into the bull market. But the problem is that we've ran out of buyers. And then eventually the price does drop below the previous bottom from the large drop right prior to it. So remember this, the way this looks. Okay? Let me put it on a weekly. It might be easier to recognize. So remember the way this looks, right? Look at that. But this actually looks worse than 2007 and 9. I mean, this looks much worse. This looks just like this. So, just to show you the similarities. See this? Rally, drop, tried to make a new all-time high, and it did for a little bit, and then all of a sudden a massive drop. This drop was a 20% drop. 20%. That the first crash. Now if we go to today, I already measured it, right? We're at a 17%. And I have a feeling tomorrow, Friday, take back Fridays, it's gonna fall. It's gonna fall further than 20%. Because nobody in their right mind would risk it right now and hold over the weekend. Because you could wake up Monday to a crash. So you're not going to hold over the weekend. No trader or investor will or should. I wouldn't recommend it. It's too risky right now. And that should take us past 20%. So there you go. Boom. The 20%, which signals bear market recession automatically. And I've said this a month and a half ago. I made that video and I made that call. For the record, I said the top is in. And this was back when the price was up here. I called it up here. Now, the reason for that is all the fundamentals and the things that are going on, and the fact that the Federal Reserve has been raising interest rates, and you already see cracks everywhere in the economy that aren't visible to a normal person when you're just driving around. You don't see, but I mean, some things are. I mean, there's a lot of malls, a lot of retailers have gone out of business. The car bubble has hit peak car bubble. You see cars parked in empty lots of malls that are empty, that have gone out of business, and you see just brand new cars parked all over the place because they can't sell them. So there was a lot of indicators that were saying that the top is in, besides the PE ratios and the earnings and everything. So and the time analysis, it's been a 10-year bull market. I mean, just by cycles, you know a bear market's coming sooner or later. Now, how much time do we have? Can this keep crashing? Well, I think the price will bounce eventually around the 78.6 Fibonacci. We'll get some sort of a bounce. It might be a weak dead cat bounce. It might be some sort of rebound, possibly. We'll see. I don't know what Trump could say or do, what rabbit he could pull out of the hat. I think the only way this market is really going to try to recover or rebound is when the Fed fully capitulates and says, all right, we will not raise rates in 2019. That will give us a nice bounce or rebound. But it's really starting to look scary, where investors are waking up to reality. And once it really sets in how bad things can be and will be, because of all of the low interest rates, cheap money printing, and the bubble that's been blown, I think the market could crash fairly quickly, like very quick, like a 50% drop, like that, like boom, in a day, which will wreck everyone. And then literally like a week later, people are going to be just getting laid off everywhere. And it could happen quick. Now, also, this is a weekly chart, by the way. There will be some major support around like 2200 S&P 500 on the weekly. There'll be some support around here as well. But I do think the 78.6 at about 2400 to 2300 S&P 500 will give us a bounce. And it might give us some sort of rebound, some sort of an attempt by the market to rebound. But the best case scenario, it just creates a whole nother descending triangle, and then it will break down again, and it will just keep doing this for years to come or months to come. I don't know how fast this is gonna play out, because things could really start deteriorating quick. I mean, once and the problem is, when you have a giant debt-driven Ponzi scheme, is when the news hits that one of these banks are going belly up, everyone's gonna sell. Everyone. It's gonna be 2008 all over again, but it's going to be way worse this time, because there's a chance. I mean, guys, I don't think the Fed could reinflate the market like it did in 2009. Because if it does come out and they say we're going to do QE this, QE that, short term, maybe for a few weeks or a few months, it might the market might rebound because people are going to speculate. But the long term, it's going to keep falling because it's going to cause massive inflation, and the taxes and regulations are still there for companies. So it's with inflation also destroys economies faster than anything, and there will be no end in sight for the bear market. And then I don't even want to get into politics. What kind of... I mean, we could get a full-blown communist president in 2020. And if we get that, I mean, it's over. Like, I'm leaving. I'm gone. Alright, let's look at some other indications here. Indicators. Oh, I also put another Fibonacci here on the weekly. This is from the bottom of 2009. So... on the macro level here, there's support around 2000. There's support around 1800. And the 78.6% is back around 1150. So to get back to 2008 levels, I mean, this market has a long way to go. So 78.6 fib is at 1100. This is gonna look just like Bitcoin. I'm dead serious. Yeah. I mean, just look at this by zooming out. Look at the degree of the fall. It is straight down. I wouldn't be surprised if this accelerates, and we close the year in 2 weeks, and we hit the blue equilibrium line around like 22,000 S&P 500. That would be would that be a 50% drop? That'd be a 30% drop. So that wouldn't be all that bad, but let's see the drop, the biggest drop in 2008 and 9. So the largest drop, and I consider this entire move, well, I can't consider that. Well, the largest drop in a span of 6 months was a 54% drop on the S&P 500 here. Let me zoom in so I can see this better. So the largest crash ever in US history fell about, I'd say 42%. 42% drop. Right now we're at about a 17% drop. Yep. Alright, so let's take a look at a few other things. NASDAQ E-mini 100. Not looking good. There's a nice little wick right here. There was some buying, but it's like not even a dead cat bounce. Very bearish. Here's the FANG stocks. Staying true to the channel, right? Couldn't break out of the channel. Also, the FANG stocks are what are going to make and break this market, and Facebook's about to go bankrupt. Just being honest, guys. Nothing looks good. It just really does not look good. What is this? Oil. It's tanking still. And that's because the economy's slowing down. You don't need as much oil. But the thing about oil is it's also manipulated by governments and the Saudis and the deals Trump does with the Saudis. I mean, cheap oil helps the economy stay afloat. cheap energy. It boosts economies, especially oil. Everything runs off of oil still, you like it or not. Financial sectors, I mean, they are really below their support on the well, it doesn't matter, but their first major support, I mean, it cut right through it like a hot knife through butter. It's on the second support now. All right, the Russell 2000. These are 2,000 smaller companies, and this is the real barometer of the economy. And this isn't international. You see, the larger companies, the S&P 500, the top 500 Fortune companies, those are international. They're global companies. This is domestic, U.S. domestic smaller companies, and they're coming up on support right now. And we'll see if the Russell could bounce. If the Russell bounces, and so does the NASDAQ, I think that'll help the Dow and the S&P rebound. So I would really keep a close eye on the Russell 2000. So I was going to talk about a bunch of fundamentals, but I don't want to make this video too long. And I've covered the TA pretty well. Oh, I'll have to look at gold as well. Let's take a look at the monthly here. Let me put on another indicator, see if it could tell us anything. Not much. Yeah, I mean, look at this. The MACD on the monthly for the S&P 500 has a long way to go. It's very bearish. Although the RSI is oversold, and so I'll have to put out other indicators on this, alright guys? I will have to do more charting and TA on the traditional markets. I have all my other indicators on my brokerage account or my platform, so I don't use, well, I use TradingView to look at things, but when I trade on TD Ameritrade and Interactive Brokers, which actually has really sweet indicators and charting software. Alright, let's take a look at gold and dollar and all the rest. Gold had a massive rally today. Well, a big rally considering what it's done in the past few years, right? So there was a cup and handle. I already showed you guys that. Wait, hold on. Cup and handle, and it did break out. And it had a nice rally. And today, intraday, we went up to 1270, getting close to 1300. Now, once gold can break above 1380, it's in a full-blown bull market, in my opinion, just looking at technicals. Now, this could still pull back, but this is a good sign that gold's going to recover and go into a bull market. It's also a bad sign for the stock market and equities. The gold is one of the indicators and barometers of the health of the economy and the stock market. Unfortunately, guys, the financial markets shouldn't really be attached too much to the real underlying economy, Main Street, but because of central banks, it is now. And it's like something crazy. Over 20% of the economy has become financialized, and that is another reason why people lose their jobs and suffer when the stock market crashes. If we had a truly free market, it wouldn't be as much correlated. It's always going to be correlated, but not as much. 10-year Treasury, I mean, it's been falling. Another interesting thing going on here is the dollar daily chart. Again, we had a cup and handle, but the dollar sold off and gold rallied, which is very interesting. That might be investors pricing in the Fed is going to eventually capitulate and throw in the towel and start lowering rates again. Soon as the Fed lowers rates, or even says or even mentions another round of QE or money printing, the dollar is going to tank. Gold and silver is going to take off. Maybe even Bitcoin and cryptos will take off, which they have recently in the past few days, and it's been a great trade. So I will just leave you guys with that. We can look at one more thing I do want to mention. Well, no, you know what? I'm going to leave that for another time. I wanted to talk about the largest companies in the stock market by market cap, and I wanted to talk about them and their performance personally, because these monopoly corps, I mean, there's so many ETFs and derivatives of them. When they start going down, they're going to pull down the entire market along with them. I will also talk about Europe and all sorts of things. I even I started making notes on all the things I need to talk about. I need to talk about pensions, tax receipts, the London fix. There was more banks being caught manipulating gold and silver, Europe, bonds, the yield curve, the psychology of traders and investors right now. We're starting to see the psychology change, especially in the past 3 days. This week has really shaken the market and the psychology of the traders and investors. JP Morgan, they actually came out and they said that a recession is coming in soon. The probability's high right now. And there is a global sell-off of equities. And I need to show you guys charts of China and Europe again and start comparing them to the US. But yeah, guys, the top's in. I'm still sticking to my call, and that's all I have to say. Another reason, this is going to become a problem. This is going to be an issue. Total national U.S. unfunded liabilities, 116 trillion. That's with a T. Not a billion, not a million. Trillion. How much is 1 trillion? 1,000 billion. How much is 1 billion? 1,000 million. Like 1 trillion, I think if you took like $1 bills and you put them on top of each other, would go to the moon or something. I need to bring some visuals up so you guys understand how much money that is. Liability per taxpayer, $948,000. So if everyone had to pay for Social Security, you know, all the pensions and all the liabilities the U.S. promised, all the free shit, every taxpayer has to pay about $1 million. An average American makes like I don't know. I think it's around 35,000, around 40,000 a year. This is ridiculous. Yeah, this is completely unsustainable. I mean, people are delusional. They're acting like this doesn't matter. It's going to matter. Now, I know this is usdebtclock.org, but even if the numbers are off by 10%, it doesn't matter. That's how bad it is. Alright guys, if you enjoyed this video, thumbs up. Please share it on Twitter, Facebook, wherever you can, Telegram, chat rooms, or whatever. And leave in the comment sections your thoughts and opinions. I will comment on it if you have a question or if I find something you're saying noteworthy, I guess. And check out all the links below the video. Join us in our free chat rooms. We share ideas and whatnot. And the MMG Invest website with the newsletter and educational material is coming soon, and it will help you survive and thrive during the largest wealth transfer in human history. Alright guys, until next time.